Okay, so you've heard a few graphite stories, but Sovereign is the first company who has actually built a cost-up project from the start. And how have we been able to do this? Well, initially in our exploration programs, we went out looking specifically for soft rock hosted graphite, right? Saprolite hosted graphite, and this gives us a significant advantage. We're looking at a really simple operation with substantial cost benefits over our peers. So, we have a rare combination of exceptionally low capex and exceptionally low OPEX compared to our peers, with a clear pathway to production. We've got the world's lowest OPEX in terms of production cost and lowest capital intensity. We've got a relatively simple strategy of mining and processing graphite to a high quality concentrate and selling that to the existing market, the existing industrial market. We're in a stable jurisdiction in terms of Malawi with a clear pathway to the market. The company's fully funded to DFS, and we have a world-class board and management team with Ian Middlemas as the chairman. So as I said, it's the lowest cost graphite development in the world. And how are we able to be low cost? Well, the entire deposit is hosted in soft saprolite material. So this is basically clay that is formed from the weathering of a primary deposit over millions of years. But the graphite flakes remain pristine and do not react in this environment. So basically nature is doing half of the separation work for us. So what does that leave us with? That leaves us with about a 25 metre thick soft saprolite profile, which has a very low strip ratio and is free dig. So in terms of mining, no drill and blast. In terms of processing, no crush and grind. And you'll see later that those elements give us significant cost, both capital and operating cost advantages over our peers. We've got the world's largest saprolite hosted resource, and it has a nice high-grade core of around 9 million tonnes at 10% graphite. As I said, it's near surface with free dig mining and low strip ratios. In terms of the flow sheet, really simple, with no crush, no grind, just put it through a scrubber and then the standard flotation process after that. We're not resource constrained. We've selected a production level to be about 5% of the global market. So we also have huge exploration upside, so we can expand if and when needed to. The saprolite advantage over our peers. Very simple operation with enormous cost advantages. So, as you can see from this diagram, no drilling, no blasting, standard load and haul, no crushing. Instead of using a mill to grind the material up front, we just put it through a scrubber to disaggregate. So this material is highly friable and basically falls apart in your hand, so it doesn't need much energy at all to be separated. So this deposit has the potential to deliver really low production costs with best-in-class margins. We're right at the bottom of the operating cost curve at around $300 a tonne FOB, so lower than the peers, much lower than the two peers that are presented before us. In terms of capital intensity, we're the lowest of all peers. And really low capital costs. The operations are simple mining and processing only. And in terms of marketing, we'll be looking at the traditional markets, the traditional industrial markets, which are about 85% by value of the flake graphite market at the moment, and moving into the battery market as that market continues to grow. The project has fantastic infrastructure. We are in Malawi, which is a landlocked country. However, we are 20 kilometres away from an operating rail line, which is also receiving $70 million investment to upgrade the 200 kilometres from the junction at Nakaya in central Malawi to the capital city, Lilongwe. Now that rail is operated by a consortium dominated by Vale and Mitsui, and they've given us a cost estimate from the mine gate, including trucking, of just $65 a tonne. Now that $65 a tonne of transport costs is included in our FOB cost of $300 a tonne. So let's have a brief look at the project economics. We completed a scoping study in June last year. Our average operating cost, FOB Nacala, came out at $301 a tonne. Now, if you want to get that to China, add $40 or $50 a tonne to make that CIF. But $300 a tonne delivered at the port. Total capex of US $29 million. That includes 35% contingency. It's a very simple plant. Using really conservative graphite pricing, some of our peers with similar flake decks are suggesting $1,500, $1,300 basket prices. We are looking at $1,100 or $1,200 at the moment, taking a conservative view on the price, and even taking that conservative view, we get a payback of 1.5 years or under 1.5 years. We've got a total 17. Just using the high-grade portion of the resource, we have a total of 17 years mine life, averaging about 44,000 tonnes of production a year. Here's our cost build up on the left here, and on the right you can see the various payback times at various pricing scenarios. So even at a really bearish $800 a basket price, we pay back our entire capital in 2 years. And in terms of margin, well, substantial margin, even in the most bearish graphite pricing environment. So we're, as well as having fantastic margin on the upside, and even at today's prices, in a really bearish environment, this project has substantial margins. Okay, our low-cost strategy is a simple and lowest risk path to market. The low cost will enable us to enter the existing traditional refractory markets, and when the time's right, the growing battery supply chain. You can see our peer average cost down here is around $500 a tonne, average FOB production cost, and our peer average capex is around US $150 million. In terms of capital intensity, in terms of operating costs and capital intensity, we are right down at the bottom of the curve at $300 a tonne operating cost, and importantly, in terms of the capital intensity, that's the capital required per tonne of annual production. We match Syrah's very large 300,000 tonne a year scenario. Note on that, they're only looking at producing 150,000 tonnes a year at the moment. So many of our peers are only economic at an unrealistic scale and unsustainable pricing scenarios. Just some technical details here. Well, as I said, we've got the largest saprolite-hosted graphite resource in the world, 29 million tonnes at 7% graphite. That includes our high-grade production target of 8 million tonnes at 10% graphite. Now, this is all close to surface, all within 25 metres of surface. It has a really low strip ratio, as I said, and it will all be free dig. We expect to announce a resource upgrade in the coming months when all the results from our infill drill program come in. In terms of processing, well, we can produce high-grade concentrates via a very simple process flow sheet. There's no primary crush, no primary grind. We obtain significant capital and operational cost benefits over hard rock processing because of this. The plant is a modular design. All the pieces of the plant are off the shelf, per se, and we're able to produce very high-grade graphite concentrates across all flake size fractions, and we're in the top 2 or 3 in terms of the quality of our concentrate, both in terms of grade and flake size. Just quickly on the graphite market, as I said before, currently the existing traditional industrial demands, refractories, foundries, etc., expandables are 85% of the market. So we're initially targeting that market, and later we'll move into the battery supply chain, which is rapidly gaining momentum. To compete in the market, you need to be able to compete with Chinese supply. And we, having such low operating costs, we will be able to compete with the Chinese and indeed land material in China. Okay, where are we at? Just to summarise, our pre-feasibility study will be finished in June this year. Product sales agreements are ongoing and underway. Definitive feasibility study will be completed in December 2018, and we'll be looking to be on a project finance footing in early 2019. Just to summarise, it's the world's largest soft saprolite graphite resource. It's high grade, low strip ratio. No requirement for drill and blast, no requirement for crush and grind. We're looking at a marketable production volume with scalable upside. We're the best in class in terms of OPEX, best in class in terms of capital intensity. We've got access to low cost infrastructure, in particular rail and port. We have the ability to, because we're so low cost, we have the ability to enter the existing industrial markets and the future battery supply chain. Our low capex should facilitate ease of funding the project. Thank you very much.